In every era, humanity has believed it understood its own money, how it moves, where it comes from, and what it represents. Yet behind the numbers we trade every day lies a quiet machinery most people never notice. A machinery that decides who rises, who falls, and who spends their entire life running on a treadmill they never agreed to step on. To understand real power in today's world, you don't start with armies, ideologies, or even technology. You start with debt. Because debt, more than anything else, is the engine that turns the global economy. And once you see how it works, you can never unsee it. Every dollar sitting in your wallet is not simply money. It's someone else's promise to repay. That isn't a metaphor, it's the core architecture of the modern financial system. If you possess money, it exists because somewhere else in the economy, an obligation exists to match it, a mortgage, a government bond, a corporate loan. Our global economy rests on this strange contradiction. Money looks like wealth, but at its foundation, it's really a claim on future repayment. Yet almost nobody stops to ask the obvious question: why? Why must our money be born from debt in the first place? And what would it look like if it weren't? History tells us this isn't some unbreakable law of economics, just a choice societies have made. But to understand why we chose it, we have to take a hard look at how our system actually creates money today, because most people picture it completely wrong. Let's start with banks. People often imagine banks as simple intermediaries. They gather deposits from savers and lend that money to borrowers. Clean, intuitive, easy. But it's largely a myth. In reality, when a bank issues a loan, it doesn't pull that money from someone else's account. It creates new money by typing numbers into existence. If you take out a $100,000 mortgage, that money didn't exist yesterday. It appears the moment you sign, and you owe it back with interest. Multiply that process across millions of mortgages, credit lines, business loans, and you begin to see the true picture. Most of the dollars in circulation today were created the moment debt was issued. Governments do the same thing. When tax revenue isn't enough, they borrow. They issue bonds, promises to repay with interest in the future. Investors, banks, even central banks buy those bonds, and in the process, fresh money flows into the economy. But once again, that money is tied to obligation. Future taxpayers must settle the bill. Every war, bailout, and social program financed through borrowing adds another layer of debt woven directly into the currency we use. And here's the uncomfortable truth: the whole structure only works as long as debt keeps expanding. If households stop borrowing, the money supply shrinks. If governments stop issuing bonds, liquidity dries up. It's like a shark that must swim nonstop to survive. The system collapses the moment debt stops growing. That's why central banks get nervous when lending slows. It's why interest rates are slashed to push consumers back into loans. It's why inflation is tolerated. The system lives on growth, and its fuel is debt. More debt means more money, and more money slowly erodes the value of every dollar already in circulation. That dynamic also widens the wealth gap. Those who lend, banks, investors, financial elites, collect interest. Those who borrow, everyday households, small businesses, pay it. Even if you personally eliminate your debts, you cannot escape the reality that every dollar you touch is built on someone else's liability. But this wasn't always the only way money worked. The debt-based system isn't a law of nature, it's a decision. And throughout history, societies have experimented with very different designs, some brilliant, some disastrous, all reminders that money does not inherently require debt. Take ancient Mesopotamia. Over 4,000 years ago, farmers borrowed grain from temples, and obligations grew quickly. Kings realized that strict enforcement would tear society apart. Their solution? Debt jubilees, periodic mass cancellations that reset the system. Not generosity but preservation. They understood that endless compounding debt could destroy a civilization. Consider medieval England. For centuries, the crown relied on tally sticks, wooden sticks split in half, carved with notches to record amounts owed. These weren't interest-bearing loans as we understand them today. They were records of obligation that circulated as currency for over 500 years. A medieval economy functioning on pieces of notched wood, lasting longer than many modern financial systems. Then there was commodity money, gold and silver coins whose value came from the metal itself, not from anyone's IOU. It created stability, but only until the supply of metal shifted. When silver poured into Europe in the 1500s, inflation exploded. When supply tightened, economies froze. Commodity money was honest but rigid. Even in recent history, alternatives have appeared. During the American Civil War, President Lincoln introduced greenbacks, paper money issued directly by the U.S. Treasury, not backed by debt. No bond issuance, no interest. They were simply money. And for a time they worked. Soldiers were paid, suppliers funded, and the government remained operational. But once the war ended, powerful banking interests pushed to eliminate them, because money created without debt threatened the profits of lenders. Of course, not all experiments ended well. Revolutionary France issued assignats, backed by seized church lands. At first, they stabilized the economy. But once politicians began printing more, confidence died. By 1795, assignats were nearly worthless. The failure wasn't due to the idea of non-debt money, it was due to lack of restraint. Any currency, debt-based or not, can fail when discipline disappears. Together, these examples reveal a simple truth. Money is a design, not destiny. Debt-based money is only one blueprint among many. And today, even if they aren't mainstream, alternatives are still alive in different corners of the world. They may not dominate global finance yet, but they prove the point. Debt-based money is not the only path available. It's just the one we're living in. Think back to Switzerland in the 1930s. The Great Depression had frozen the financial arteries of Europe. Banks were collapsing, credit had evaporated, and small businesses were suffocating, not because they lacked goods or skills, but because they lacked the one thing the system demanded: money. In that vacuum, Swiss entrepreneurs built their own lifeline. They founded the WIR Bank, a financial institution unlike anything in the traditional system. Instead of lending francs at interest, it used a mutual credit network that allowed businesses to trade with one another directly. A carpenter could purchase lumber using WIR credits. A baker could hire repairs with the same internal currency. No compounding interest, no escalating obligations, just recorded trust circulating between members. And here's what most people miss. Credit is not inherently debt. Credit is simply a record of trusted exchange. Debt is what happens when that record is loaded with interest and enforced obligation. The WIR system still operates today, with tens of thousands of businesses using it as a stabilizer whenever the wider economy stumbles. It stands as living proof that credit doesn't have to become a financial shackle, and that money doesn't have to run through commercial banks to function. Now consider local currencies. The Bristol pound in the UK, Berkshires in Massachusetts. These currencies don't come from central banks, they come from communities. A Bristol pound is worth exactly £1 but it can only be spent within the region. That simple constraint keeps wealth circulating locally instead of being siphoned off to global corporations or distant financial hubs. No, these currencies don't free people entirely from the national debt treadmill. But they show something powerful. Money can be built to strengthen communities, not just enrich creditors. And then there's the wild card, cryptocurrency. Bitcoin emerged in 2009, forged in the ashes of the global financial crisis as a direct rebuke to bailouts, central banks, and money creation through debt. The mysterious creator, Satoshi Nakamoto, designed it to be the mirror opposite of modern currencies, capped in supply, independent of governments, and untouched by bond issuance or bank lending. New bitcoins enter circulation through mining, and the total supply can never exceed 21 million. To believers, this is financial emancipation, money no government can inflate or quietly siphon through policy. To skeptics, it's unpredictable, hype-driven, and too easily swayed by large holders. But whatever your view, Bitcoin makes one point undeniable. Money does not have to originate as debt. It can come from code, consensus, and mathematical scarcity. Governments themselves are now exploring alternatives through central bank digital currencies, CBDCs. At a glance, that sounds redundant. Don't central banks already issue money? Yes, but only the foundation, cash and reserves. Over 90% of money in modern economies is created by commercial banks through lending. That's the fractional reserve system most people never think about. The number in your checking account? It isn't central bank money. It's money created by your bank when it issued loans to someone else. A CBDC flips that script. It would allow the central bank to issue digital money directly to the public. Picture a digital wallet managed by the Federal Reserve or the European Central Bank. The balance you hold isn't a bank's liability, it's direct central bank currency. This could break the commercial bank's monopoly on money creation. But the trade-off is sharp. While CBDCs might loosen the grip of debt-based money, they could also hand governments unprecedented control. Every transaction could be monitored. Spending could be restricted, paused, or even set to expire. A system designed to free you from private financial power could, with the wrong policies, bind you to state authority instead. Then there's the concept of resource-backed money. Historically, gold and silver filled that role. Today, the idea is evolving. What if currencies were tied not to metals or government bonds, but to measurable resources? Imagine a unit of currency backed by energy, 1 kilowatt-hour equals 1 credit. Or a carbon-based monetary system, where each unit represents the right to emit a fixed amount of CO2. This goes beyond carbon credits. It proposes a world where the planetary carbon budget becomes the foundation of value itself, just as gold once was. Your paycheck would represent shares of the planet's remaining emissions allowance. The advantage? Severe discipline. Governments couldn't expand the money supply arbitrarily. The risk is equally clear. Linking money to ecological limits could create intense rationing and immense political leverage. Still, these ideas make one thing undeniable: we are not locked into debt-anchored money. We can link currency to trust, communities, code, or physical resources. From Switzerland's WIR system to Bitcoin to energy-pegged designs, the message is the same. Money is not an inevitability, it's a blueprint. Our current system dominates not because it's the only model that works, but because it's the model that most benefits those at the top. Banks reap interest. Governments borrow without raising taxes. Financial elites accumulate assets while citizens accumulate obligations. This is not an accident. Debt concentrates power upward. And yet, throughout history and across today's world, people continue building alternatives, proving that money can exist without chains of interest, without IOUs, without perpetual obligation. None of these systems are flawless. Gold is stable but rigid. Local currencies nurture communities but struggle to scale. Cryptocurrencies promise decentralization but face volatility. CBDCs could bypass banks but risk turning the state into an all-seeing treasurer. Resource-based systems discipline money creation but centralize political authority. The point isn't that one solution is perfect. The point is that every solution reflects a choice, and debt money is just one of those choices. So why does this matter now? Because the cracks in the debt-driven model are widening. Global debt has blown past $300 trillion and continues to climb. Governments borrow endlessly to patch fiscal shortfalls. Households juggle mortgages, student loans, and credit cards that never seem to shrink. Inflation erodes purchasing power, turning wages into vapor. And every time the system falters, the cure is the same: more debt. Lower rates, more money printing, more bonds, more rescues. Each intervention tightens the treadmill rather than slowing it. This isn't an abstract macroeconomic argument. It's the world you live in. Your taxes, your mortgage, the numbers on your paycheck, these all exist inside a design that depends on your continued participation in debt. Even when you personally avoid borrowing, your government issues new debt in your name. Your bank multiplies your deposits into loans. The balance you see in your account isn't true wealth, it's someone else's promise to repay. But here's the encouraging truth: none of this is destiny. Debt money isn't gravity, it's architecture. And architecture can be redesigned. Mesopotamian kings erased debt when it threatened to tear society apart. Medieval England flourished for centuries on wooden tally sticks. Lincoln's America financed a civil war with debt-free greenbacks. Communities around the world use local currencies to shield themselves from global shocks. Switzerland runs a mutual credit bank that has endured nearly a century. Bitcoin, flawed or not, shows that money can spring from code, not obligation. These aren't perfect systems. Each trades one set of problems for another. But that's the lesson. Money has always been a moving target. So what should we take from this? First, understand the mechanics. Most of the money in your life was created as debt. Inflation, inequality, and financial instability are not bugs. They are built-in consequences. Second, recognize money as a tool, not a natural force. It can empower communities or funnel wealth to elites. It can stabilize economies or destabilize them. Third, never confuse convenience with security. A system that feels smooth today can still unravel tomorrow. History is full of currencies that collapsed overnight once trust evaporated. Real financial literacy isn't just budgeting, it's understanding the structure beneath your feet. If inflation melts the value of your savings, do you hold assets that survive? If the debt machine accelerates, do you know how to step off? If confidence breaks, are you prepared? Money doesn't have to equal debt. It can represent trust, resources, sovereignty, or stability, but only if we demand a system built on those values. History doesn't repeat itself perfectly, but it echoes. And the echo is unmistakable. Every civilization that tied its fate to debt alone eventually buckled under the weight. The survivors were those who remembered the simplest truth: money is designed, and designs can always be rewritten.